In this lesson, using multiple time frame analysis, the learning objective is you should know how to trade using multiple time frame analysis. Multiple time frame analysis is a trading technique that uses more than one time frame to analyze a trading setup. Multiple time frame analysis will give you a better perspective on what is really happening in the market. You can use it with higher time frames to identify the bigger trend, as well as using lower time frames for better entries and a much more accurate timing of the market. Trading along with the higher time frames can increase your chances of success in trading because that's where the smart money usually operates in the market. Smart money being banks and large institutions. Generally, higher time frames have more significance than lower time frames. There are two major rules for multiple time frame analysis. Rule number 1, larger time frames establish and dominate the trend. And rule number 2, reversal start from the smaller time frames first and propagate upwards. Taking a closer look at the rules, rule number 1, which was larger time frames establish and dominate the trend, means that when a larger time frame trend is currently in place, you will see pullbacks on the smaller time frames. A trend on longer time frames has more time to develop, which means that it will take a bigger market move for the trend to end compared to smaller time frames. Rule number 2 was reversal start with the smaller time frames first and propagate upwards. This means we'll see a changing structure show up on the shorter time frame charts first. You should use 3 time frames when carrying out multiple time frame analysis: a long-term time frame, a medium-term time frame, and a short-term time frame. Examining a long-term time frame will show you the dominant trend. It is commonly advised to trade in the direction of the dominant trend to capture more profit. The medium-term time frame is the most flexible due to the fact that it has components of both long-term and short-term frequencies. When using this time frame, you are able to zoom in on the broader dominant trend and see the smaller components of the trend. Applying the medium-term time frame is particularly significant as you should plan your trade at this stage. The short-term time frame is the point of action. While examining this time frame, price fluctuations become increasingly more clear. Due to this, it is easier to choose a point of entry. It is important to note that fundamental components and economic indicators do play a role in this time frame, but only for a short time. During these periods of increased volatility, you should avoid entering a trade. From long to short term, each time frame has its benefits that are crucial when it comes to participating in a trade. When all 3 of the time frames are considered and employed correctly in the evaluation of pairs, the probability of success for a trader improves significantly. When you're trying to decide how much time in between time frames, just make sure that there is enough difference for the smaller time frame to move back and forth without every move reflecting in the large time frame. If the time frames are too close, you won't be able to tell the difference, which would be pretty useless. There is a 3 step-by-step process you can use for multiple time frame analysis. Step 1. Start checking the larger time frames. Check larger time frames to see if there's any potential trading setups forming. It gives you a better and bigger picture of what is happening. Larger time frames can hide good trading setups that are forming in smaller time frames. That's why when you do a top-down technical analysis, you don't miss a thing. Questions to ask yourself when looking at larger time frames include: is price near a major support or resistance level? Is price near a major support turn resistance or resistance turn support level? Is price near a Fibonacci level, and does it coincide with other support or resistance levels, trend lines or channels? Is price forming a channel, and where is the price now in relation to the channel trend lines? Is it close or not? Is price heading towards a major trend line? And are there any chart patterns forming in the larger time frames, for example, the head and shoulder pattern? In step 2, you should note the trading setups that will happen during the week. This allows you to focus on trading setups that will most likely happen within the trading week or trading setups that can happen in 1 to 2 days. You should draw your lines, trend lines, channels, Fibonacci retracement levels, and wait to see if price will reach them. You need to make a note of them and constantly monitor them because sometimes prices can travel fast and reach them, and you can miss those trading setups because you are not watching and monitoring them. Just a callback to a lesson a while back, which was trading view. You can use websites like TradingView to just create alerts that will help you avoid missing these good opportunities. The third step for using multiple time frame analysis to trade is you should switch to a smaller time frame. If you found a good trade setup on a larger time frame and it has now been completed, you should now switch to a smaller time frame. If it is a sell setup, look for bearish candlesticks on the smaller time frame as a sell trade entry confirmation, and if it is a bullish trade setup, look for bullish candlesticks on the smaller time frame as the buy trade entry confirmation. In conclusion, applying multiple time frame analysis can greatly improve the outcome of a trade. Multiple time frame analysis provides a comprehensive view of price that will result in a larger profit target for a trade. Multiple time frame analysis requires a lot of practice because often different time frames can produce conflicting signals. However, if you have straight rules and if you look at each time frame for specific patterns, you can have a much clearer view of the overall price action.